Markets have again focused on politics this week, with an ongoing focus on trade. With this focus on US-China trade relations, global equities have fallen over the week and bond yields have moved lower on risk aversion. Australian equities have notably outperformed, up 3.5% on the week, perhaps helped by the lower Australian dollar. As trade-sensitive proxies, the Australian and Kiwi dollars both fell heavily this week, while the US dollar remains slightly firmer, still supported by the Fed's tightening path and the likely monetary policy divergence with much of the rest of the world. During the week, the Australian dollar fell under 74 cents on Trump's latest tariff threats against China, reminding us the Australian dollar remains very sensitive to the US-China trade battle. There are reports of further White House negotiations and hopes that President Trump is just using these tariffs as negotiating tactics, but right now it looks like neither side is backing down. The Australian dollar is now at a 13-month low, while the New Zealand dollar is at a 7-month low under 69 cents. As well as trade, the Kiwi has been weighed upon by local GDP data. New Zealand GDP rose by 0.5% in the March quarter, with the annual rate slowing to 2.7%, confirming that the economy has lost some momentum as firms took a cautious approach to the new government and with the local housing market cooling. For Australia, there was no major economic data this week, so the market focused on the RBA minutes and a key address by RBA Governor Lowe at a central bank forum in Portugal. Lowe covered similar themes as in recent speeches, and when discussing the inflation outlook, he acknowledged many of the global structural factors holding inflation lower and making the system look less inflation prone. Therefore, he signalled a willingness to accept lower inflation outcomes as long as employment growth remains solid. And after all, that might be preferable than cutting interest rates to stoke inflation when there was a greater risk around asset prices and household balance sheets. While discussing central banks, the pound was briefly boosted by the Bank of England policy decision last night. Rates were left unchanged at 0.5%, but they surprised markets with the vote showing 3 dissenters calling for a hike. In fact, it was Chief Economist Haldane's first ever dissent. The Bank of England also said they would consider selling their portfolio of assets purchased during their quantitative easing programs sooner than the market had expected. Underpinning the Bank of England's more optimistic outlook is their assumption that the dip in growth in the first quarter will prove temporary, with momentum recovering in the second quarter. But bigger forces are at play here. With the Brexit referendum almost 2 years ago to the day, the March 2019 deadline is approaching and progress is achingly slow. This might prove a big assumption. For the week ahead, focus will certainly be on potential US-China trade escalations and again on European politics, with Italian concerns flaring up again with the appointment of known Eurosceptics to key positions within the new government. Now, neither of these issues appear likely to be resolved anytime soon, and this could continue to provide additional background to support for the US dollar. The Australian data calendar remains quiet, and the market will focus on trade headlines and related concerns regarding China. But while commodity prices hold up, the Australian dollar looks set to tread water around 74 cents, barring any surprise positive news. We'll be back to talk to you next week.